Welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Today is the second of three videos as we discuss the equity outlook for 2022. Joining me today is Rob Romano, our Director of Research. Rob, we've obviously seen an incredible recovery off the pandemic lows in the stock market from March of 2020. What have been some of the contributors to those, and what do we see in 2022?
Yeah, the returns in the market have been amazing. And we believe there's two big drivers of those returns, one being the Federal Reserve and other global central banks, and the second being just the strong recovery we've seen in corporate profits. So on this slide here, you can see the massive amount of liquidity provided by global central banks. And a lot of that liquidity ended up in asset prices, like stock prices. But we think going forward, the Fed's going to be in the spotlight after the highest inflation reading in 30 years. So they're going to have a bit of a balancing act to try to negate the negative effects of inflation without upsetting the financial markets. So there is a risk of a policy error, and that would be the Fed raising rates too far, too fast. We think that's unlikely given the comments we've gotten from the Fed about moving at a measured pace, but it is a risk factor as we head into 2022. In regards to corporate earnings, we saw a sharp recovery in corporate earnings coming out of the pandemic as the economy reopened. Companies restructured their businesses, operating margins went to record levels, but we're at the point now where the growth rate in those earnings has peaked. With that said though, we still expect to see corporate profits for the S&P 500 up in the high single digits, which is a fairly strong number. And our confidence in that is based on a couple of factors. One is simply the rebuilding of those inventories. We think that's a 2 to 3 quarter event. We heard from John Deere 2 weeks ago, and they said their inventories are at 10-year lows. So in addition to that, corporate and consumer balance sheets are very strong, and we think some of that money gets spent throughout 2022.
Rob, thanks for those comments on corporate earnings. And one of the interesting things about the indexes and this surge that we've seen is that the makeup of the S&P in particular has really changed as far as the mix of stocks. Can you kind of explain how that has changed and how that impacts diversification in portfolios?
Sure, we've seen indices change and really the composition of those indices change. I would have never thought in my career that we'd see two companies worth almost $3 trillion each. But if you just look at the S&P 500, there's 5 companies within that index that make up 22% of that index, and one sector that makes up roughly 26% of the index, and that being technology. And with technology being the highest weighting, the S&P 500 has moved to more of a growth bias than where it was 10, 20 years ago. Furthermore, if you look at some of the sectors within the S&P 500, like technology, there's 3 companies that make up almost 50% of that sector, that being Apple, Microsoft, and NVIDIA. And also in consumer discretionary, there's 3 companies that make up almost 50% too, that being Amazon, Tesla, and Home Depot. So when you think of diversification, it's been reduced significantly given these concentrations that are out there. Also, our manager research team, we do all the due diligence and research on mutual funds and exchange-traded funds. And it's not uncommon that we'll see 2 funds with different investment styles, like large cap growth and large cap value, own some of the same securities. So that's just another level of the lack of diversification right now.
So Rob, obviously one of our core philosophies is diversified portfolios, and so we work very hard when we think about diversification in portfolios and weightings in individual companies and sectors. What is our current weightings in the equity portfolio?
Yeah, so currently we have a 5% overweight to the equity market. Again, we think it's going to be challenging another year for fixed income. Within equity, we have a 70% weight to large cap. We have a 10% weight divided equally between mid cap and small cap, and a 20% weighting to international, divided equally between developed international and emerging markets. In regards to growth versus value, we've had this persistent overweight to growth versus value over several years. We did pull that back last year when we added some more value, but we still have a slight overweight to growth. And how we think about the equity market right now, the S&P 500 is trading at 21, 22 times forward earnings. That's at the high end of the historical range. Historically, the S&P 500 is traded around 15 to 16 times earnings. We still think 2022 can be a positive year for the equity markets, but volatility will increase significantly just given the uncertainty around Fed policy, inflation, and interest rates.
Rob, really appreciate those comments. For those of you watching, please pay attention to your email. In about a week, you'll receive our third and final video as we discuss a few longer-term trends that we see occurring in the markets. For those of you who are our clients, you'll also be receiving a hard copy of our 2022 Outlook, which is being sent right now to you. And always, thank you for the opportunity to work with you and your family. Thanks and have a great day.